The global currency market may have just experienced its most critical structural catalyst of the year. While retail traders chased short-term tech momentum, elite macro desks quietly repositioned for a major regime shift in British sterling. Deutsche Bank's lead strategist, George Soros, recently signaled that the British currency is finding robust support in an unexpected place, the rising political momentum of Andy Burnham and his projected move toward 10 Downing Street. This isn't just standard political speculation. It represents a fundamental repricing of the United Kingdom's structural risk premium, driving capital back into a currency that has spent years under a cloud of political instability. But understanding this currency momentum requires us to look deeper at the underlying structural engine of the United Kingdom. London remains one of the world's premier financial capitals, backed by institutional banking heavyweights like HSBC and Barclays. These institutions form a deep capital moat, acting as global liquidity hubs that channel cross-border flows. When political rhetoric shifts toward stability and regional growth, it directly reduces the country's sovereign risk discount. For institutional investors holding global currency baskets, a more predictable political landscape instantly makes sterling-denominated assets highly attractive relative to peers. That institutional depth is what establishes London's enduring economic moat, even during macro downturns. Think of major UK financial assets not just as banking operations, but as critical structural conduits for global wealth management, clearing services, and debt underwriting. When we evaluate the Sterling Trust ETF, ticker symbol FXB, we are looking at the direct beneficiary of these systemic flows. As domestic political risk declines, the liquidity premium demanded by foreign buyers shrinks, transforming a volatile trading instrument into a highly insulated defensive reserve asset. Now look at how the latest balance of sheet metrics are validating this structural backdrop. While earlier projections feared stagnant GDP growth, recent quarterly bank earnings from Barclays and HSBC have demonstrated surprising resilience. Net interest margins have remained wider for longer, supported by a central bank forced to keep rates restrictive to combat sticky services inflation. These robust margins have bolstered bank balance sheets, leading to aggressive capital return programs through share buybacks and rising dividend yields, which further attracts offshore yield-seeking capital. This liquidity flow is not just an equity story, it directly reshapes the nation's balance of payments. For several quarters, the UK ran persistent current account deficits, requiring constant foreign capital inflows to defend the currency. However, the recent stabilization of energy costs combined with resilient service sector exports has begun to narrow these deficits. When capital rotates back into domestic gilts and FTSE equities, the structural demand for sterling increases, creating a compounding positive feedback loop for the currency. The next signal comes from how elite macro desks are interpreting the political transition. George Soros at Deutsche Bank notes that the run-up to Burnham's expected move to national leadership has acted as a powerful psychological flaw. Burnham's rhetoric has consistently focused on regional devolution, infrastructure development, and stable public-private partnerships. To institutional investors, this represents a pivot away from chaotic, ideologically driven policy shifts toward a highly technocratic, investment-friendly administrative style, significantly reducing the country's sovereign risk discount. But rhetoric alone does not fund projects, which is why capital allocation strategies are shifting. The anticipated policy framework emphasizes long-term capital expenditure over short-term consumption spending. For global asset managers, this signals a transition from debt-fueled fiscal instability to productivity-enhancing infrastructure investments. If executed correctly, this policy shift could raise the UK's long-term potential growth rate, providing a major structural tailwind for both corporate earnings and the domestic currency. To see where this capital lands, we have to contrast it with the global competitive landscape. The Eurozone is currently grappling with persistent structural stagnation, and the US dollar is facing long-term fiscal deficit concerns and shifting interest rate expectations. In this environment, the United Kingdom offers a unique mix of high nominal yields and improving political clarity. This relative strength explains why sterling has outperformed major G10 currencies during recent consolidation phases, transforming it into a vital capital refuge. Here is where the monetary policy differentials become highly supportive. The Bank of England has maintained a highly cautious approach to cutting interest rates, citing persistent domestic wage pressures. This hawkish bias contrasts sharply with other major central banks, ensuring that the UK's yield advantage remains highly intact. For institutional carry traders, borrowing in lower-yielding currencies to purchase higher-yielding sterling assets has become a highly lucrative play, providing steady, structural demand for the pound. Yet, no investment thesis is complete without evaluating the tail risks. Despite the positive political momentum, the UK economy faces major structural headwinds. Government debt to GDP remains near 100%, leaving very little room for fiscal experimentation. If a new administration attempts to fund regional devolution through massive unbacked borrowing, bond vigilantes could easily return, driving gilt yields up and triggering a sharp depreciation in the currency. This sovereign debt dynamic leads us to a bigger question regarding terminal regulatory risk. The UK banking sector, led by Barclays and HSBC, operates under strict post-crisis capital requirements. Any attempt by new political leadership to overregulate the City of London in the name of consumer protection could choke off the very credit creation that drives economic growth. If we see early signs of margin contraction or rising regulatory costs, it would immediately serve as a major TRIM consideration signal for domestic bank exposures. With these risks mapped out, where does the structural valuation model point next? Historically, sterling has traded at a significant discount to its long-term purchasing power parity due to Brexit-related uncertainty. As political stability returns, this structural discount is starting to dissolve. Asset allocators are looking at a potential return to historic trading ranges, which would represent a massive capital appreciation story for long-term holders of sterling-denominated assets. That brings us to a critical tactical assessment for global asset allocators. As the pre-move rally under Burnham's anticipated rise consolidates, traders are actively searching for the next major catalyst. This will likely come in the form of concrete policy drafts or the next Bank of England policy meeting. Until then, the structural carry trade remains highly supportive, cementing sterling's status as a premier candidate for a continuous breakout watch. Let's synthesize these developments into a concrete institutional framework. On our breakout watch, we have the British Sterling ETF, ticker FXB, as political risk decompression drives structural capital inflows. On the other hand, we must maintain a TRIM consideration on UK domestic lenders if new political leadership introduces hostile regulatory frameworks or if credit quality degrades under persistent high interest rates. Balancing these opposing forces is key to insulating your global portfolio. This structural evolution is precisely what we track here on SR Money News. We cut through the retail noise to deliver elite, institutional-grade market intelligence directly to you. To ensure you stay ahead of the next major macroeconomic pivot and preserve your capital, subscribe to the channel now, hit the notification bell, and share your thoughts on the future of sterling in the comments below.